moved to 2/3 mortgages and 1/3 to business. So I really want to talk from in your bank's point of view. What are the barriers to lending to businesses, and with a particular focus on small businesses? What makes it hard to lend to businesses, or why do some businesses come to me and say they just can't get money from their banks?
Thank you for the question, Ms. Spender. One important point to note is that NAB is quite different from most of the other Australian banks. If you look at our balance sheet, 56% would be to residential home lending and 44% would be to businesses. We are the biggest lender to businesses in the country, and would be far the biggest lender to small and medium-sized enterprises in the country. And what's very pleasing is that over the last 5 years, since I've been at the bank, both as CEO and prior to that running the business bank, we've been growing our business outstandings at double the pace that we've been growing our housing outstandings. So for us, at least, it is not a case of us skewing away from businesses. We continue to lend into that part of the economy. And have lots of appetite for lending to small and medium-sized businesses. I think that doesn't mean that everything is perfect in terms of access to capital for small and medium-sized businesses. I think it's true to say that Australia tends to focus on more secured lending than unsecured lending than I've seen in other markets that I've worked at as a banker. Now, some of that is because secured lending is cheaper for the borrower, and therefore, that could be the customer's wish to actually have security over a physical asset, because it means that they can avail themselves of lower levels of interest. But it is still the case that, when you look at the mix of lending in our country, it does skew to secured versus unsecured.
And certainly, I think that's absolutely right, and certainly does in the small business sector. And I think with the housing market, which is increasingly unaffordable for young people, this is the concern that we're getting. Who can run and earn money, who can sort of put their house up against a business loan if they're unlikely to have a house. So I think this is, some of the challenge that you mentioned in the start from that intergenerational equity point of view in terms of that secured, unsecured piece. But I guess then the question is, are there things from a policy point of view that would make it easier, or make sort of credit flow more effectively to small, medium businesses? And considerations might be things like the COVID securitization program that was, or guaranteed loan that was there. I think some people talk to me about responsible lending thresholds and whether they should be raised. So you could look at different areas. I'm just interested if you've got any views on ways that could help unlock more capital, particularly for SMEs.
Yeah, I think one of the, and some of this is going to also involve non-bank capital. Australia needs a larger venture capital and private equity market, right, so that particularly growth companies and companies seeking to scale can get access to growth capital. And, the US and other markets are just more advanced in having more growth capital. I think there's a little bit about the risk appetite in our country and questions around that. But I think that's an area that I hear from our customers that we could do more as a country. And now we have the Australian Business Growth Fund, and there has been a more emergence of potential solutions, but I think we still have a fair way to go there. And then, in terms of bank lending, again, Australia has, pretty robust and strong, risk appetite parameters. When you compare to other jurisdictions, the levels of bank losses here are much, much lower than you would see in other markets. Some of that is, frankly, by design. Australia is a unique economy. We have the fourth largest pension fund industry in the world, growing to the second largest in about 10 years, which for a country of 20-odd million people is truly remarkable. But what that means is that we export pension capital across the world, and we're a big provider of capital for long-term assets like infrastructure. So we export capital at the superannuation level. We then import capital at the bank level. The reason for that is twofold. One is more Australians have money in superannuation versus holding it on bank deposit. So in other markets with smaller pension markets, they would have more of their personal wealth in a banking system. So deposits in other markets are higher. And in Australia, we hold mortgages on balance sheet. And Australian houses are very expensive. So our banks have much higher levels of assets and lower levels of deposits, which means we don't fully fund our assets ourselves. So we go globally to raise money to fund our mortgage books and our business lending. And so when you are requiring to access capital globally, it's helpful to have unquestionably strong banks that can borrow overseas for as cheap a rate as possible. So that is a dynamic that's real in our country, just of in terms of the makeup of our capital markets. And I think our regulator's very cognizant of that, that if Australian banks had a somewhat weaker capital position, and we got into a little bit of trouble, would that have implications to bank viability? And so having a very strong banking system is important.
So is that fair to say, though, that is it an inevitable consequence then of wanting a robust banking system that, that we, and we do have a lower risk appetite for, for business lending? Is that an inevitability, or is there something else that we can do on this which both preserves the strength of our banking system and doesn't put that in jeopardy, but also gives more money to the businesses, which we know we want to fund, and where business investment, frankly, in this country at the moment is really low, and that's a problem for all of us.
No, I think that's a conversation that needs to be had in our country around, is the calibration of our settings exactly right? I wouldn't expect us to have a very significant change. I can see why Australia is adopting Basel III as a medium-sized country that is essentially importing capital at the bank level. But it's always about calibration. And, could we change a few settings on calibration? Potentially. And I think that's a conversation that's worth having as a country. A lot of the dialogue around productivity to date has been around productivity of labour. We haven't had as much dialogue as a country around productivity of capital. And this would come under that.
Okay, thank you. I think I'll hand back to the Chair. Thank you so much for your time.
Oh, it's very good of you. Thank you very much. I'll hand over now to the member for Moreton for the next 10 minutes.
Thank you, Chair, and thank you for providing evidence today. I was going to start with AI, and I asked a question of your counterpart from the ANZ in reference to some job losses at the moment, and the question was this: are the roles or functions or responsibilities of employees going to be replaced by AI or automation? And I wanted to ask you the same question with respect to your employees more broadly.
Yeah, I think, as I said in my opening statement, AI is going to be one of the most consequential technology innovations in our lifetime. And I believe it will be as significant as the motor car, as electrification, as the internet. And all of those things ultimately improve things for the better, but they had positive and negative consequences to employment. And I think that will be the case here. I think the most important thing that we can do as a country is to encourage our workers to lean into AI, learn, adopt, skill up, because, the narrative I've used in the past isn't that AI is going to take our jobs. It's that workers who know how to use AI well are going to take the job of workers who are afraid of AI. And so we need to make sure that as a country, we are skilling our labour force up to the greatest possible extent to maximise the opportunities that are going to come as a result of this technology.
Does that mean you think that there will be job losses as a result of AI and automation?
Over time, I think there will be, but we shouldn't run away from that. We have an economy that is short labour today. We're the country's biggest business bank, and when I talk to my business customers up and down the country, access to labour, skilled labour and unskilled, is one of the biggest challenges that I continue to hear. We're coming at the end of an economic cycle that's been a bit difficult for us, and unemployment is pretty incredibly low levels. So there isn't that much capacity in the workforce, and so.
So where do you see deployment of AI in terms of the functions for NAB?
For us, I think we're excited about the opportunity in software development. Mm-hmm. We're excited about the opportunity in customer contact. We have deployed a Gen 1 virtual assistant that talks to our customers that the NPS on that is 35 percentage points higher than the more clunky traditional virtual assistant that we had as a bank a year ago. And it's defraying thousands upon thousands of calls where customers would have had to wait on hold and talk to someone. And so they're really enjoying that capability. And I think, over time, the quality and capability of these solutions are going to improve to the point that you actually won't know unless it's disclosed that you were talking to a robot, either via text or through voice.
Do you think that use of that technology has the potential for NAB to create cost savings for customers?
Potentially. I would like to think so. We run our bank where we're looking at, revenue and the cost to generate that revenue. And so obviously if we can reduce costs over time, that would be good. And I'd imagine share some of that with our owners and shareholders and some of that with our customers. But I can't overemphasize the point that we need to lean into AI versus run away, and reskilling and helping our staff is going to be incredibly important, and we are really focused on that as a bank, training and running workshops and training sessions to help them get up to speed. It's still early days, but this is coming to us.
I was going to ask, where is the customer data being stored for AI systems, and if it is being stored overseas, what controls do you have in terms of security and safety of that data?
No, we're very clear that all our data for Australians is housed onshore in Australia.
Okay. I want to move to payments, and we've seen obviously a lot of discussion of payments, and banks more broadly have said that they're supportive of banning surcharging but not supportive of the RBA reducing interchange fees. What's your view on that?
I do agree with the notion that surcharging has passed its useful date. It was introduced in another era when credit cards were a small proportion of the payment system and debit cards weren't used significantly. And now that's simply not the case. And so, I was here a year ago at this committee and shared a personal story where I was slugged a 10% surcharge for a cup of coffee. And so it was being abused as well. And so I think for all Australians to have certainty on the price of a good or service, I think is a good thing. What we also believe as the country's business bank is that small businesses should not pay the freight of that change. And so we need to work to ensure that the cost of acceptance of payments for small businesses continues to be reasonable. Australia is fortunate that today we are one of the lowest cost payment jurisdictions in the world, but I'm still in favor of and working with the RBA through their consultation process to minimize the cost of payments to small business. And we have engaged in that process. So it is also true that we think the current recommendations as described need some work and need some tweaking. Our view is that there are things that we could be looking at, like reducing interchange for small business up to a certain revenue level that we would be supportive of. Mm-hmm. Another approach would be differentiating around card present, where there's a physical card, or card not present, which are typically e-commerce payments. And I think many of the small businesses that would be impacted through surcharging would take card present payments. So there are a number of ways that we are engaging with the RBA to, I think, try and be part of the solution and support the essence of what the government is trying to do, which is to create certainty around payments so we know what the cost of a payment is, while ensuring that small businesses are not significantly disadvantaged with that change.
So for clarity, you would support a reduction in interchange fees for small businesses? Correct. Yeah. Some banks have claimed that any reduction in interchange fees would result in would essentially see a reduction in fraud and other protections. Do you disagree with that?
We are spending significant amounts of money on frauds and scams. We spend more today than we've ever done. And I think that the safety and security of payments is not something that I would see being compromised.
By a reduction in interchange.
Correct. I think the concern that the banking industry has with the current recommendations as described is that the economics around the payment industry will be sufficiently harmed that it would reduce the ability for banks to further invest in the payment ecosystem, first of all. And second of all, it significantly harms domestic companies and banks in terms of reducing their profit pool while not touching the profit pool of large international companies, either tech companies, schemes, American Express, and what have you, and that we need a more integrated approach to looking at this topic.
Thank you. Just a quick couple on home loan offset accounts. ASIC's obviously raised concerns about potential issues with the application of home loan offsets as they should be operating. When you saw that, did you undertake any investigations into the operation of your home loan offset accounts, and what did those investigations show?
Yeah, we are working with ASIC. They've told us about their surveillance activities in this regard, and then we're looking at that to make sure that we're in good shape. We think we are today. What we're trying to understand is, have we been in the past, and make sure that there hasn't been any issues in the past. But we're actively working with ASIC on this matter.
Okay, thank you.
Terrific. So I might hand over now to the member for Bowman, if he's there.
I am here. Thank you, Chair. We've heard from the other banks this morning and yesterday in relation to their predictions in terms of interest rates for the new year. Just keen to get the House view from NAB on what you're expecting. Will we see rates lower at any point in 2026?
No, we do not. And obviously, this is a matter for the RBA, but our prediction is that we will not see further rate cuts next year.
Okay. And what do you predict inflation's going to be doing over that period?
we predict that inflation is going to come down marginally, but continue to be stubborn. The issue that we have as a country right now is we're growing around 2%, and next year we'll be growing 2.3 to maybe 2.5. And that's about as good as it gets for us now. As a country, we can't grow much more than 2.5% a year without triggering excess inflation. And this comes all the way back to my opening statement around the need for more productivity in our economy. Because without more productivity, growing at between 2 and 2.5% is the trend rate that we can achieve for the foreseeable future.
And do you maintain an assumption around what Australia's productivity trajectory could be over the next little while?
We live in a wonderful country that has, as I've said, abundant energy resources, that is a place that the rest of the world wants to come and live and work. We can attract the highest quality migrants the world has, the best, because of the wonderful country that we live in. We have got English language, rule of law, beautiful beaches, lots of capacity to grow. We shouldn't have a housing crisis when you think of the amount of land we have in this country and the amount of people we have in this country. And so, Australia has been one of the best places to live and work for the last 100 years. And there's no reason why Australia shouldn't be one of the best places to live and work for the next 100 years. The issue right now is we are not today set up to replicate the incredible 100 years that we have had. And I think that ultimately is what this discussion around productivity is all about. And I've said before that generation after generation of Australians, people came to our shores and they could have absolute certainty that their children would live a better life than they would.
Would you say that we are facing, in our first time in our history, we're facing the prospect of having a lower standard of living in the next generation?
I think for the first time in our history, that is the problem. That for the first time in our history, parents can't look at each other and with conviction say their children are going to have a better life than they did. And that's what every parent wants. And that's what every parent could say with impunity for the last 100 years. And I think, this is absolutely the dialogue we need to be having as a country. And it's within our hands.
Well, I want you to dig a little bit deeper on that one. We've got a lot of policy levers that we can control in the building you're sitting in at the moment, not necessarily the building I'm in, but wondering, if you could just sort of crystal ball a bit, and what I'd be keen to do is get your perspectives, particularly from what you're hearing from your customers. Where are the challenges at the moment? Where are the obstacles to their growth? And what should we be doing as policymakers? If you give us a top three, or don't let me restrict you.
It's what I started off in the first place. It's housing, it's energy, and it's regulation. And they're the three things that we need to push into as a country. The biggest reason why Australia has plateaued on productivity is that in the last 10 years, all the jobs we're creating are in the public sector. 9 out of 10 jobs that we're creating are in the public sector. And the public sector typically is lower productivity work than in the private sector. And the reasons for that are the three reasons I mentioned: the housing crisis, the energy crisis, and it's making it too difficult for businesses to do what they want to be doing and do their work.
Would you say that federal government expenditure is squeezing out private investment and leading to stickier inflation?
I would say all government expenditure, not just federal government, is doing that. We had, post-COVID, a very significant fiscal stimulus in order to save the economy, frankly, from the public purse to the private purse. And that needed to happen. But ultimately, what it's meant is that if anything, the public purse is today more constrained than the private purse. And so, I think a bit more fiscal restraint on all parts of government is going to be important here to get the fiscal house in order, again, at the state and the federal level, and to kind of make way for the private sector to grow.
Okay. Can I just unpack a bit any other insights that you've got from across your book, particularly I'm thinking of your SME customers. Where are you seeing hardship? Where are you seeing risk? Where are you, as we look forward to the next year, where are the areas of concern for you or your customers who fit that cohort?
The first thing I would say is actually things are getting better. So that's not to say that there isn't still some concern, but things are getting better. And I'll give it a whack, but Peter, maybe I'll bring you in momentarily too, so you can think about what you might want to say. Firstly, on the consumer side, what's been pretty remarkable over the last year is we've had 3 rate cuts by the Reserve Bank. And at NAB, we give our customers the choice of whether or not they want to maintain their payments at the levels they're at, or they want to reduce their payments as a result of the base rate cut. And today, 80% of our customers have chosen to maintain their payment levels. In effect, they're paying down their loan faster because more of their payments are paying down principal and less is going to paying for interest. And that's a sign of them managing their money quite well. It's not to say there isn't pockets of hardship. There certainly still is. But it's not Middle Australia that's facing it. It's typically renters or younger families that are having a tougher time. Middle Australia's actually doing quite well. If I turn to businesses and the commercial sector, a year and a half ago, there was a fair bit of stress in the economy with rising input costs. Energy was a big one, but not just energy. All goods and service input costs for our business customers were rising significantly. And over time, they were finding it less easy to pass those costs on to their customers. And so businesses were getting squeezed and margins were being impacted because of that cost pressure. We have seen that starting to abate a little bit. A great example that's quite encouraging is in construction. I live in Melbourne, and I've heard from some of my large developer clients that they're starting to see some of their subbies coming to them with cost reductions and saying, I can do this work for 5 or 10% less now. Some of that, I think, is because we're seeing a bit of the big build in Victoria coming down, and so some workers are being able to move to residential housing, which is a good thing. But that's a positive thing. So I think the input cost inflation is starting to abate. And so generally speaking, we think that hardship and delinquency is going to improve over the course of 2026, and that Australia is actually going to have a very good year next year. But maybe, Peter, I can bring you in.
Yeah, thanks, Andrew. I mean, it's a really, really good summary. Broadly, we're about where we would expect to be at this time in the economic cycle. I mean, typically what you see is that households start to improve first, and we've seen that, and I think that you would see that across the industry. There are overs and unders across the states, but broadly, household delinquencies are improving. Across non-residential, so business lending, there are overs and unders across sectors, but broadly, as we've just described, our outlook is that interest rates aren't going to come down because the economy is broadly doing pretty well, and that will support business. But there are hotspots. So, for example, particularly in the agri sector where there's been drought, that has caused particular challenges for some of our customers.
Okay. Thanks for your questions. Mr Pike, we'll be able to come back. I'm intending to provide 10 minutes of additional questions for every member. With that, I'll hand over to the member for Reid.
Thank you, Chair. And Mr Irvine, I want to congratulate you because you have managed to get furious agreement from a selection of the committee members about your statements regarding a push to more renewable energy and gas as quickly as possible and potentially being able to reach net zero by 2050 without jeopardising energy prices. That vision of Australia being a superpower when it comes to energy is something that you seem to have gotten agreement on. So I congratulate you on that. I just want to ask you...
Boutros Irvine.
I want to ask you, like these projects, they are a long time in the making. They take a while to build and plan. Would we be in a better position today getting to your energy superpower vision had we had a strong and consistent energy policy, say, 10 or 15 years ago?
Yeah, I think businesses and investors like certainty. And so the more we can have clear, defined parameters, the better. And the reason is the amount of money that is required to effectively deliver the transition to net zero is enormous. And as a result, the payback periods for investors to make a return on that investment are going to require 30, 40, 50 years of stable settings. And so whenever there is concern around what those settings might be, I think that can create a frigid response to capital because capital wants certainty. And if capital can find certainty in other markets, it will go there.
And they're looking for certainty from government, I assume. Government in terms of their own commitment to net zero.
From everybody. From government, society, and also the value chain as well. So absolutely, yes.
So any deviation from certainty, or if it becomes politicised for whatever reason, does that make it harder for us to become that energy superpower that you had that vision for?
My view is that we need to be focusing on the things that I highlighted earlier in this testimony, which is projects and getting projects delivered, and that I firmly believe that, again, we can bring all the energy we need domestically to have very low-cost energy and meet our net zero objectives, and that dialogue that is, changing what those parameters are makes it harder.
Can I ask about your views on direct financing for thermal coal-fired power stations?
Yeah, we haven't lent money to thermal coal in about 10 years, and we now have zero outstandings to thermal coal. I think outside of some remediation guarantees.
Yeah, some rehabilitation bonds, about 100, yeah.
Rehabilitation bonds. So we are not financing thermal coal.
And why not?
Because it's inconsistent with our policy setting around our financed emissions aligning to Australia's Paris commitment and net zero.
I am particularly interested as well in your discussions around housing and agree with the points that you have made, and would love to hear more about the, I think, the $60 billion fund that you have set up around housing. How, and it strikes me that it's a slightly different model in terms of financing. You're looking for third-party capital.
Yeah, on the, so it's our ambition is very significant, and it's for both demand and supply. And I'll take supply first because actually that's the more important lever for our country. What we have said is that we want to originate and deploy significantly more capital over the next 5 years than we would have in the past to help be an answer to the need for more dwelling creation in the country. and that not only are we going to use our own bank balance sheet to do that, but we are going to strike deals with third-party providers of capital that don't have our distribution. I have thousands of business bankers up and down the country that many of these capital providers don't have. And they like the quality of the origination that we do as a bank because of the risk-return profile of it, and they trust us to spend that money well. And so it's been very heartening that we've been able to do partnerships with third-party providers of capital, both Australian superannuation as well as global money that is attracted to the returns they can get in Australia. And they're happy to do that through our bank. And so, we think we can, on our own in that time, finance something like 50,000 dwellings, which is a very material contribution to what Australia needs to do. And we're very excited about that ambition, and we wanted to make a public statement around it.
Yeah, fantastic. And I applaud your ambition on that front as well. What would hold back that ambition?
I think the issues with regard to Australian housing development are well understood. We have an issue with planning being very, very difficult and onerous and taking a long time. And that ultimately is passed on to customers. We have an issue with not enough skilled construction workers in the country. And one of the things I've found particularly difficult to understand is that with the levels of migration that we've had coming into Australia over the last few years, so few have had construction skills. Something, like 5,000 or 10,000 of them know how to do construction of whatever various kinds. It should be far higher than that. There's no doubt that Australia could attract lots of people who could want to come and live here, who know how to be electricians or plumbers or bricklayers or carpenters. And so that's something that we need to work on to get more labour here. We need more medium density and high density housing dwellings because the household size of Australia has reduced pretty significantly over the last 30 to 40 years. And in fact, had we had no more Australians than 20 or 30 years ago, we would need 20% more homes because we have more people living in either single or with a partner without lots of children. And so housing sizes are smaller, which is driving demand for more dwellings. Another issue that's a difficult topic for government to hear is taxation. Taxation, it varies by state, but generally speaking, 40% of the cost to build a home goes to various levels of government. And so one of the things that we engaged in with the Productivity Commission was that we need to look at our tax settings as a country. And right now, too much of our tax take comes from housing and from land as a proportion of total taxes. That is, I think, hurting and making the housing crisis worse than it otherwise would be. So there are a number of issues that need to get addressed here to enable more housing to come to market. Now, the one thing that, and I know there's been some dialogue around house prices in this committee over the last couple of days. One thing that has been true is that house prices didn't increase as fast over the last 2 to 3 years as construction costs. Construction costs really ran away. And so a little bit of house price inflation actually could make some developments viable that were not viable in the past because of construction costs. And I am aware of a number of developments that are planning approved up and down the country, where we have said we would be prepared as a bank to finance that construction, where developers have not pressed go because of economic viability concerns. And so to the extent there is some house price inflation, that could also, over the 2 or 3 year medium term, stimulate more dwellings coming to market, which could be positive.
Thank you. I need to just move on now to Member for Casey for his next 10 minutes.
Thank you, Chair. Mr Irvine, as a senior leader, if your organisation was pursuing a long-term strategy and that was delivering certainty for your organisation, but it was the wrong strategy for the organisation and was leading to negative outcomes, would you look to stop, reassess and reevaluate and potentially change that strategy to deliver better outcomes for your organisation?
You know, when we look at strategy, we tend to think about that in 3 or 5 year terms. I think changing strategy every year can be quite destructive to an organisation.
But if you had a 25-year target and strategy, let's say, and you thought that was causing damage to your organisation, you would look to review that strategy if it wasn't working?
We actually revisit strategy every year to just test that it's aligned to our medium-term objectives and doing what we want to help drive the company. So, yes.
Sounds like sensible leadership, Mr Irving. I'd like to move across to agriculture. I know you finance around a third of the country's agriculture. My community is a strong agricultural community. It's an important part of our nation. I'm proudly from a farming family which did, bank with NAB, and we're very happy with the service. I was hoping you could provide, given the insights, and I do know firsthand that your team work closely with farmers, given the unique nature of finance in the agriculture sector. I was hoping you could provide a bit of an update, can be very top line, on how the sector's going, some of the opportunities and potentially some of the challenges they might be facing at the moment.
Yeah, generally speaking, our agricultural customers are doing very well. Commodity prices have been constructive. Harvests have been good. The price of livestock is robust, and so I would say, generally speaking, our clients are doing well. There are pockets of areas due to either things like weather that have impacted them, so floods in Northern Australia, New South Wales and Queensland, droughts in parts of Victoria and South Australia, have made it difficult, and particularly in Victoria and South Australia, some of our customers were really struggling to pay feed for livestock, and that was difficult. But I do think that's a momentary issue, and those customers are being supported by our bank and will get on their feet in time. Australia's agriculture is some of the best in the world. And our farmers are very, very innovative. In fact, if I could think of any industry in our country where we have really good technology adoption and innovation and entrepreneurship, I'm hard-pressed to find a sector that does a better job than the agricultural sector. So, you know, it's something that we're immensely proud of as a bank, to support 1 in 3 farmers. And, you know, we hope to continue to do that.
I think you'll find, as a general comment, one of the reasons farming has to be so innovative is that they are price takers, as a general comment, particularly in a country like Australia where we're dealing with 2 major supermarkets. Could you just talk through a little bit, very quickly, I guess, the economics of farming in terms of, again, their costs? What are they seeing, or what are you seeing your farmers are undertaking in terms of cost increases? Because one of the biggest, or the biggest challenge for farming outside of the weather, which has been around forever, is that they can't control the price, as I said, that they are receiving generally in market. So what are you seeing in terms of the cost base, and what are the main drivers of cost increases for farmers?
I think when I talk to our farming customers, they would highlight energy and rising cost of energy as a headwind. They would highlight the cost of fertilizer and other input chemicals as challenging. I think they would highlight access to labour as a challenge, and having good, consistent access to labour. So, you know, these would be things that would repeatedly come up in conversations with farmers when I'm with them.
And I guess more a comment, I would note that fertiliser costs are also a byproduct of energy, given it is very energy intensive. So there is in many ways a double cost there. That's before you look at the cost of cool rooms and things like that. Would you agree with the statement that, you know, energy is at the heart of ensuring our farmers survive? Lower energy prices are at the heart of ensuring our farmers survive. And if we can't control energy prices for farmers, that will be felt in the supermarket every time an Australian buys a product.
Yeah, having secure, stable, reliable and affordable energy is important for all sectors of society, and I'd find it hard-pressed to find a farmer who wouldn't agree with that statement.
But would you agree they're particularly vulnerable? Given they are price takers, they have less ability to increase their price to a Woolworths or a Coles. They have no ability, to be frank, to increase their price to a Woolworths or Coles compared to housing we just talked about. If the raw material costs of housing increases, they have the ability to increase the price to the consumer. Given a farmer does not have that ability, they are even more vulnerable to price increases for them personally, and then their flow on suppliers, whether you look at fertiliser, you know, packaging, etc., etc. They are probably the most vulnerable community in this country in terms of a business sector to higher energy prices. In my opinion, I'm interested in your thoughts on that.
I think that's a hard comment to disagree with. Farmers are working really hard to improve yields, innovate on managing their costs and optimise their costs, and they're generally very, very good at that. But your point around them being price takers for commodity prices is a fair one.
And one of the trends we're seeing in the farming community across the country, I'm seeing and talking to many farmers, is we're losing generational farmers. So, you know, in many cases, children aren't going into the business, and there's a consolidation of farmers. And in some industries, we're potentially seeing 2 or 3 large suppliers then dealing with one or with 2 large corporations, being Woolworths and Coles. Now, my theory of that trend, 2 questions. Are you seeing that trend? I'm conscious it can be anecdotal for myself. And if that trend continues, I see a risk for us as a nation that we have 2 or 3 big suppliers in each category, let's call it blueberries, 1 or 2 large corporations on the other side. The natural result of that is a comfortable higher pricing structure that costs the Australian people more. And if we don't, and the reason I ask that is because many of these farmers are getting out because of these rising costs, energy and other things. They can't survive unless you get to a certain scale. So I'm interested in your thoughts and any commentary you could add to that.
We have seen some corporatisation of Australian farming at the top end of town, for sure. So farms have generally gotten bigger and more sophisticated. Now, will that lead to higher prices? I'm not sure that's a leap that I would necessarily make, because there'd be economies of scale, adoption of technology, and other innovations that maybe larger farms are better able to pursue than smaller ones. So I'm not sure I would have the fact base to support higher prices from that. But it's also true to say that I have seen lots of examples up and down the country of farmers passing on farms to the next generation. And that gives me real hope that we'll continue to have a very vibrant, family-driven agricultural sector that's been the heartbeat of regional Australia for a long time. What's also pleasing is I'm seeing more women moving into farming and agriculture, which is really, really pleasing. I think it probably had been really a bit of a male bastion, and I can't tell you the number of agricultural customers I've visited where they're essentially led and run by women, which is just lovely to see. So I don't think all hope is lost on that. I think that our agricultural sector is still vibrant.
Oh, absolutely. And as someone that is proudly I won't call myself a third-generation farmer because that wouldn't be true. I'm not out on the farm, but as someone that's part of a third-generation farming family, it is so important that we continue that, and that is one of the fears I have, and that we need to feed the nation. I have other questions, but I'm conscious we are close to time, so I will just finish by saying thank you for servicing agribusiness, and I urge you to continue to service them the way you do, because they are so important to the country, and I will be watching.
Rolly, my tyrannical chairing has seen my name ripped off Christmas cards off the country, so I might move now to the member for Deakin for the final 10 minutes, and then we'll have a shortened break and resume at 3:30. Over to you.
No problem. Thank you, Chair. I read media reports that NAB has experienced some outages with some of its technology, including, I think, 3 hours out on its internet banking in October. I was wondering whether you found out what the cause of that last one was in particular.
Well, we're actually very pleased with our outage experience over the last few years. Our head of technology and operations, Patrick Wright, has been with our bank since 2018. And over that period of time, the number of high and medium ferocity or outages has reduced by around 80%, which is a terrific achievement. A big part of that is because we've moved over 90% of our applications to the public cloud, and the public cloud has much higher levels of resilience than was typically the case in our own environment. And more recent, we have 3 public cloud providers, and we're able to move something like 40% of our compute across those 3 cloud providers virtually instantaneously, which gives us significant redundancy. But it's also true that in any tech-intensive organization that now and then you have outages, and we have had outages. We're very conscious that, if anything, the single biggest thing that our customers dislike is when they can't use their bank's services. And so we really seek to minimize any outage. And I'll tell you, there's a learning review done on every single time there is an outage around why it happened and what can we learn to ensure that that particular outage doesn't happen again. Peter, I don't know.
If you're not comfortable telling me about the one in October, and I understand why, could you give me assurance that you know the answer to what happened?
Mm-hmm. Yes, we do.
You do?
Yeah, I mean,
excellent.
It was a simple coding error. I'm pretty sure from memory it was a simple coding error that should have been picked up and wasn't. And as Andrew said, you know, every time there's an incident like that, there is essentially what we call a major incident review, where all the teams get together. What happened? What did we miss? How can we make sure that doesn't happen again? Unfortunately,
I'd say at least 8 out of 10 instances where we do have an outage are caused by change initiated by the bank. Now, 99% of the changes we initiate go through flawlessly, but the quantum of change in our technology environment is significant, as we're always seeking to improve, and that change is the biggest cause of issues in terms of production uptime.
As you pointed out, there has been a lot of change. Some recent commentaries also pointed out in the environment where there's increased cybersecurity risk and things like that, some financial institutions still have legacy systems that haven't quite gone up to date, and that is creating a vulnerability. Has there been a focus on work to make sure that legacy systems are being brought up to date, along with all this exciting AI stuff and things like that? Because obviously the weakest point is what we need to eliminate.
I can tell you with absolute certainty that there's nothing I'm more focused on than keeping our bank and our customers' information and money safe. And that's true of me, it's true of my management team, and it's certainly true of our board of directors. We know the threat vectors are ever increasing, and we work tirelessly to ensure that our capabilities, our perimeter, and any vulnerabilities that we identify are addressed as quickly as possible. And to be fair, we have a regulator that also impresses that upon us very consistently.
Have you found the regulators in cybersecurity supports from government helpful and facilitative?
Yeah, I am actually personally on the government's cybersecurity council. And, I think the way that we are moving forward with a kind of Team Australia approach with government, ministries, telecos, and banks working together to make Australia a stronger, defensive, and harder to penetrate country. It's going very well, and we need to continue to do that. But I applaud the way that things are being done in terms of cyber defences to date.
Keeping on the theme of a cooperative spirit, regional banking branches are obviously proving a bit of a challenge for the industry to make sure that we're sustaining the full suite of regional services. So big cash floats can be collected by the RSL and the like. How is work going with the sector to ensure that there is continued presence of full bank services across the regions?
Yeah. And this has been an issue for banks for quite a long time, as the number of in-person transactions has fallen year over year, and more people are using digital and mobile ways to do their banking. Some things that are, again, a little bit different for NAB than maybe some of the other banks. We have more of our branches in regional Australia as a percentage of our total network than any other bank, maybe with Bendigo. A reason for that is we're a very big agriculture bank, and so regional Australia is significantly bigger for us commercially than it is for other banks. So commercially, regional Australia is very, very important to us. And if anyone who lives in regional Australia, you'll likely see our NAB vehicles driving around all over the place. We're a big part of towns in Australia up and down the country. I'd also say that we've gone to a place where you're going to see far fewer branch closures from National Australia Bank going forward. In fact, at the last count that APRA did, I think the industry closed 150 branches. We closed 3. And repeat that number, please. The industry closed 150 or a little bit more. We closed 3.
Thank you.
That is not necessarily because we're just being great citizens. It's because we view branches as commercially important to our service proposition. And I feel that branches have a significant role to play, and we're going to continue to invest in them. Now, I am also aware that there has been an industry peer who's extended their moratorium on branch closures. I'm not sure that's something that I think we would be keen to adopt. And that's not to say that we intend to have significant closures. That's not the case at all. But I just want to make sure that our branches are in the best possible places and they're being used well. And right now, I was just looking at our transactions per branch in the last few weeks and months, and we have some branches that aren't being used by customers. One branch in particular was being used about 3 times an hour by customers. It's just not getting the outcomes that I would want to get from a regional branch. And so, would I want to close that branch? Yes, I would. And maybe I'd like to open another branch in another regional town that would get far more usage from customers. So I'd like the ability to run the business well, but I can tell you with absolute conviction that we think branches are incredibly important. We are committed to regional Australia, and there will be no mass branch closure event while I'm in charge of the bank.
Do you think there are alternative service delivery models for some regions? Like one of your colleagues from another bank raised the potential for a single kind of location to be used by multiple bank organisations if customers come in. Obviously, then you have the vaults and all those things you need to be able to deliver large-scale cash services. Are you exploring alternative models for service delivery beyond Bank of Post, which obviously has an important role, with colleagues in other banks?
We are actually, and there's a live project that we're working on with our ABA peers. I'm still the chair of the ABA, so this is something that's been a bit of a passion project for me. And it's specifically with regard to multi-deposit ATMs. So let me explain what that is and why it's different from anything that we've had in the country today. So today, if you walk to a NAB branch and went to the ATM, any customer of any financial institution could withdraw cash from my ATM and I wouldn't charge them a fee. But only National Australia Bank customers could deposit into that ATM. And that would be true of any ATM in the country, that only the customers of that ATM's bank could actually deposit. What we are trialing that's completely new to the country is a multi-deposit ATM, that if we put it in a rural town or a very rural town, would, I think, have a big impact, because it means that every bank customer in that town could both withdraw and deposit funds into that ATM and get essentially instant credit. And that's, I think, a really big deal. If this works and customers use this ATM capability, I think that's something that we could deploy more broadly and significantly increase access to cash from both a withdrawal and a deposit standpoint across regional rural Australia.
Tremendous. On that point, we'll now break until 3:30. We will return with the member for Wentworth asking questions and then go back to the member for Deakin. Thank you. Whitworth for her 10 minutes of questions. Over to you, Allegra.
Thank you so much. I wanted to continue on a little bit on the conversation we were having earlier about access, about businesses and growth, but also a bit more about the sort of regulatory settings. Perhaps starting then with banks' regulatory settings. There's a bit of a discussion around regulating for growth as well as regulating for risk. I know one action that the government has taken has been to establish a regulatory grid for the sort of finance sector. I'd love to get some feedback in terms of how that's going and where you see opportunities for it to go further if you do see them.
Yeah, I think the notion of a regulatory grid that simplifies the regulatory posture is something that we're very much in favour of. I would say it is still early days. There have been specific areas where we are seeing some emerging outcomes. For example, around data requests, we get very significant requests for data and information from many of our regulators, and often those data requests are duplicative, slightly different, and add much more excess workload for financial services players. And so that's an example where we're seeing some emerging improvements. But I would say it is still early days. As an example, at our bank, just this year, we have had over 800 changes to the obligations that we need to satisfy from all the regulators that we need to comply with. Maybe 300 or 400 of those are net new obligations, and the rest are changes. And so, whenever you have that velocity of obligation issuance and also requirement for compliance, that's a significant burden on business and industry. And I think that we're a big bank, but when I talk to my customers up and down the country, we do hear that from many small business, medium business, large business, that this is an example of things that add to cost and cost of compliance. And so, I think having a high bar for change and for new obligations and ensuring that they are required to get good, strong business outcomes, I think is something that we would encourage more of.
And I guess if you were seeking evidence of a change of culture, what would you look for? Because I think as someone who has, I think he was a bank CEO who said regulators have no natural predators, which is one of the things that has amused me as in terms of an expression. But I think more broadly, it's a challenge in public policy to sort of measure if we're actually making progress on something like right-sizing regulation. And so I'd be interested from a bank's point of view, how would you assess that either from your customer point of view or your own point of view to see whether we are making a sort of better balance of regulation and risk than we have historically?
How would you answer that, Peter?
Thank you for the question, Ms. Bender. I mean, there are, I think, probably a couple of data points that I can offer. We responded to 91 consultations last year, and as Andrew mentioned, there's 800 obligations, which is probably about 20% turnover in the total number of obligations. So, Chair, you mentioned at the beginning, and we responded about we need to be relentless and ongoing on managing risk culture and governance. That's because our organisation is not static. It's changing all the time. People are changing, systems are changing, processes are changing, obligations are changing. So in terms of what would help, I think it is, obviously it is good to be consulted, but can that, is the velocity or the volume of consultations potentially, as well as reporting. We are, there is reporting that commenced during the COVID period, which we're still doing. So, the ability to withdraw the need for reporting that served a valuable purpose at a point in time. Is there still a valuable purpose in the effort that goes into producing that reporting, and it goes to Andrew's point about productivity. It's just one more small drag on the productivity agenda.
An example I might offer on the risk of performatory legislation on obligations. I was out visiting a customer maybe a year ago that was a food manufacturer, and it's a small business. They were a South African couple who'd emigrated here maybe 10 or 15 years ago, and they manufacture essentially food from home for the South African community in Australia. And the specific issue that caused them real stress in their business was that there had been a change in the requirement on the size of the font on the label for the food that they sell. And unfortunately, the printing capability that they had was not able to deliver that new font. And so this is a small business that turns over, maybe $700,000 or $800,000 a year. And that change forced them to buy a $60,000 printer that added nothing to their customer experience or how they run their business. It was a real cost impost to them. And in that, did the person who was making that change in obligation in a government who was probably very well intended, did they know and were they aware of the consequence of that small change? And I give that as an example because it's exactly the type of thing that small business owners up and down the country regularly complain about. That makes it harder to do business here.
Yep. Okay, thank you. And I have many sympathies for that sort of, as you say, for that change, which is probably well-intentioned, but obviously has real-life impacts. My question then was just sort of to follow up on some of the comments you made earlier, was about the productivity of capital. You pointed about, we talked about labour productivity, and you were saying the productivity of capital is an area that we're not thinking about enough. Where do you think the opportunities are for productivity of capital in the economy that we're not realising?
Yeah, let me again provide some global context, and then we can go into that specific question. So given how Australia has adopted Basel III and essentially what we call unquestionably strong framework for our banking industry, what that means is that we hold higher levels of capital for Australian banks than you would have with international counterparties. And if you compare us with, say, the US, which has a very deep capital market, so one could argue that's not a fair comparison. But just for me to bring this alive for you, if we were a US bank with the amount of capital that we hold, we could probably lend between 30 and 50% more. So in terms of the productivity of a dollar of our capital, it's 30 to 50% lower than it would be the case in the US market. Now, as I said, there are, I think, some good reasons for that to be true, given that we import capital at the bank level, and we're obviously a smaller, medium-sized nation and don't have the depth of the capital markets than the US does. But as I said at the beginning, I do think there is a dialogue and a debate to be had around whether the calibration of our settings is right, and are there areas that we could or should be tweaking, and I think a place to potentially push would be around business lending, and do we have the right risk parameters and capital weights for different sectors and different types of lending, and are we happy and good with our calibration and settings versus where they otherwise might be. So I just wanted to share that as just some perspective, and there are always trade-offs here, because if you move and tweak that calibration, you might see on the margin a little bit more probability of default, which could create more loss events over time. You could marginally increase the risk, and I think this would be very marginal, of possible bank failures, which you don't ever want to see. But these are, I think, the things that you need to always be weighing up as a society. We take it for granted that we don't have bank failures in this country. The US has them quite regularly. I wouldn't want to live in a financial ecosystem where that was the case. I think that's very stressful for depositors. And so this, I think the sanctity of your deposits always being safe in an Australian bank is a very important parameter. But this is a good place to spend some time as a country on whether or not we've got our settings exactly right.
Thank you.
Okay.
Thanks very much.
Well, thank you. I will pass it back to the Chair. Thank you so much for your time.
Thank you very much. And I'll now hand over to the member for Deakin and then go to the member for Bowman.
Thank you, Chair. I was wondering if you could update the committee on the work your bank is doing in relation to customers who may be experiencing financial abuse.
Yes. In fact, I have some. We were the first bank, I think 4 or 5 years ago, that introduced monitoring on financial abuse within payments. I think we see something around like 170, 180,000 cases a year of abusive language associated with a payment. So what we do in that instance is we provide a written warning to the customer. And thankfully, when we do that, well over 90% of customers cease and desist from doing that. If they do not, we would then move to seeking to exit them from the bank because we simply have no tolerance for that type of language being used across our platforms. We also have spent significant time training our workforce to be able to better identify possible cases of financial abuse, be it elder abuse, partner abuse, domestic violence, and there are a number of potential vectors there, frauds and scams as well. And it's difficult, especially when the abuser is a family member and in a position of trust. And so that can be quite tricky and quite challenging. We also, as a bank, have grants that we give to people who have suffered financial abuse. These are grants that do not need to be repaid, in the kind of $2,000 level, but they, at the time of need for a potential victim of financial abuse, they can be life-changing for them. And so that's also something that we've been really focused on. This is a dynamic and evolving place, but, we see some heart-wrenching stories of our customers being victims here, and we do our best as a good corporate citizen to try and help wherever we can.
So you were saying, and quite understandably, that the scenarios where it is a family member doing the abusing, perhaps they've got a power of attorney, that those are tricky situations. Can you outline any things you can and have done in that space to support individuals?
Do you want to take
Yeah. So thank you for the question, Mr. Gregg. We've got a specialist team that's been trained to deal with this. They call the Customer Support Hub to deal with these particular sorts of circumstances. One of the measures that we've put in place is that in particular circumstances, say for example domestic or family violence, where an account might need co-signatures to operators, we've got circumstances in which we can enable one person to operate that account safely to access funds would be one measure, an example.
So that makes it easier to get the money.
Yeah, so so they can access their funds. If they might normally require the permission of what might be a violent partner, for example, and they're in shelter, there is now a process that we can work through that will enable to access their funds without having to get the co-permission, if you will, of that alleged domestic violent partner.
So what about a situation where the person in the position of power holds a power of attorney, for example, and is clearly trying to facilitate a transaction that makes no sense, like a child of a client is trying to withdraw $200,000 or move it into their own mortgage account?
We watch that. We have significant transaction monitoring around that, and we see elder abuse where children, frankly, are sometimes looking to extract funds from vulnerable elderly parents. Again, we have a specialized team that looks into that, and it can be very difficult, and some of those conversations can lead to violence in our branches and those types of things too, which are really difficult.
So you mentioned that you're training staff to spot abuse. Is that training delivered across kind of reporting lines, all customer-facing roles and management? Which parts of your team are given that training?
I think all staff get mandatory training on financial abuse and spotting financial abuse. Then staff members that may see it more frequently would get additional training. And then in addition, we have this specialist team that deal with that all day long, and they would be our most advanced people in this area.
So colleagues can call them and go, look, well, this is the scenario, what do you think I should do, as well? Correct. So in that space, is there also the monitoring that you're using for that? Is that also applied to mule accounts to see if transactions are a bit sus, and so you can intervene?
Mule accounts have been really, really difficult for the industry. And there are times where mule accounts are mules at the time of origination because there's been identity theft. More often than not, accounts that were legitimate and in good standing become compromised, again, through identity theft. People, unfortunately, disclosing credentials that they shouldn't have done. And more recently, we've seen a significant increase in accounts being sold. We see that with foreign students leaving the country who have opened legitimate bank accounts. They're now leaving, they've done their studies, and it's a quick way to earn $100 to sell your account. You can go on to certain social media platforms and in broad light of day see advertising for, buy a bank account. That makes things really, really challenging for us because, you've suddenly got an account that is going to start acting differently, and then we need to potentially create fiction and block payments if we think something's going wrong. And unfortunately, we do that with legitimate accounts as much as mule accounts, and it's one of the areas where customer complaints have been rising, where we may have felt that an account might have been a mule because we're seeing practices changing from precedent where it actually was legitimate. And so this is an area we're constantly tuning our algorithms to get better. Pleasingly, in the last year, I think we were the leading bank in terms of identifying mule accounts and shutting them down. And we're going to continue to push in really hard on that because it's hard to scam customers if you've got no account to put the money to. And so that's a key vector for us to increase the safety of Australians, is to be a really difficult bank for mules to use.
Are you seeing business accounts misused as well, either through just false merchant coding or transfer or theft of businesses' accounts?
So business email compromise, for example, yes, that is possibly this, after investment scams. That's probably the second most significant vector of scams and fraud that we see, and our frontline bankers regularly are working with our customers and identifying opportunities and reminding them if one of your suppliers is asking you to send money to a new bank account, for example, they've changed their bank account details, that's a trigger that you absolutely need to check. But that is a very significant vector of financial crime.
We're constantly educating our customers. We had a very large payment go through. It was actually in the public domain, well over $100 million. And it was a case of invoice fraud. And in this case, the company thought it was a bit of an odd one because the accounts had changed. But where they made a mistake was they called the number on the fraudulent invoice. and essentially corroborated that the invoice was real with the fraudster. Not the phone number that they had on file. That was the miss. And so we're constantly educating our customers to be vigilant here. The concern on the business side is that the amounts are bigger. And so the potential gains for criminals are larger. And so they're naturally drawn to businesses versus consumers because of the prize.
Are business bank accounts themselves being misused?
It's possible that business bank accounts themselves are either being used by mules or by organized crime. Again, we work really hard to identify that, work with police and with AUSTRAC. But, you know, these criminals are sophisticated. They have, you know, high needs for earning, and they are relentless in pursuing opportunities to capture our hard-earned money.
Thank you. Member for Bowman.
Thank you, Chair. I just wanted to dig in a bit further to some of the answers that you gave to questions that I asked and some other members asked around the obstacles in the way of greater level of housing construction and greater housing supply. Mm-hmm. You mentioned planning approvals or, you know, regulatory hold-ups. I'm just wondering if you had any, and feel free to take this on notice, but do you have any particular insights as to where in the planning process that's occurring? Is it at the local level? Is it state level? I've got a lot of ones in my electorate that are held up through EPBC issues. Keen to get your perspectives on that.
I would say both. I think the predominant areas where we see significant friction is at both the local government and state government level. You know, there's very different levels of housing approval velocity at the local government level. And I think having more transparency around how local governments are doing on approvals, approval timelines, the amount of conditions that they are setting on developments would be really helpful because I don't think there's sufficient accountability around that. To give you a great example, I had a client in Sydney who was looking to get a development built nearby one of the new railway stations that are being approved. And this would be a classic example of where you would want high-density housing. They applied for a building that would have 30 stories, and I think they got approved for 8 or 10. And that's a terrific example of what not to be doing, because you actually have a location that can support density because of that train station. And so, you know, there's just, it's an approach of all the things that I can do to stop development versus asking yourself, how can I enable this to get done? It's kind of changing the mindset in our planning teams, both at local and state government, that I think would be helpful.
Do you maintain any data on that? Do you have any sort of metrics by which you're measuring that, or is it just a pattern that you've noticed?
Well, we certainly hear lots and lots of anecdotes, but, you know, I wonder if we could get information on, you know, how many development applications would have material changes required as a result of engaging with planning departments. You know, it's another area of transparency that I might encourage local authorities as well as the states to start showing.
Yes, it's an interesting one because it's one of the most vexed challenges that we face as policymakers. Yet it's one of the areas where we have the data is actually very opaque, particularly across all levels of government. But I was intrigued to see whether you had anything from your customers. But if you could maybe take that on notice, that'd be helpful.
We can find that.
The other one, can I just one quick one on that one before I move on to something else? Are you noticing a difference in the infill versus greenfield approach? Is it more apartments that are being held up? or is it across the board?
No, it's across the board. Yeah, we need more medium and high density, so we need more apartments and more townhouses. Those will also help with housing affordability and intergenerational inequality, because those dwellings are more likely to be lower cost. And so the more dwellings like that we can deliver, I think the better it will be, because, we need to get Australians into the housing ladder. And, in most parts of the country, it's going to be in apartments or townhouses that people will be buying their first home.
Oh, absolutely. And you also mentioned about the need to get the balance or the focus right in terms of what skilled occupations we're bringing in through our migrant channels.
Yeah.
And you mentioned the significant, lack of or the massive gaps that we've got in construction. Are there any other areas where you're noticing through the insights of your customers that where we are falling short in terms of skills?
I think STEM is another area. Science, technology, engineering, manufacturing. Australia is still not producing sufficient quantities of STEM graduates from its universities. So I think that's an area where we could push into. Construction certainly was an area. Hospitality 2 or 3 years ago was a big shortage because we had so many people leave our shores during COVID, but I think that's been addressed now. But the point I would make is that as a country, we should have a very dynamic immigration setting. And I think Canada is a good example of a country that's done this quite well, where every year you look at your economy, you look at the skills that your economy needs to grow and prosper, and then you're adjusting on some sort of point system the migrants that you want to be taking in more of. And so if you need more people with construction skills, you essentially should lower the bar for those people so that you will get more of them. And then when you have sufficient quantities, you can raise the bar and skew to other areas that will help drive your economy. So I think having a more dynamic focus on the skills the economy needs and adjusting regularly so that we get those people into our country would be really helpful.
Excellent. In your view, what regulatory and policy settings would best support the safe and responsible and accelerated AI adoption across Australian businesses? We talked a bit on AI, but I'm really keen to dig in a little bit deeper there. I'm assuming your instinct would be don't over-regulate it too quickly?
Yeah, for now I'd say less is more. And let's avoid over-regulating. I was at a panel a year and a half ago, and a question was asked about one of the panelists around where do you think Australia could lead in AI and AI adoption? And the response from the panelists was in regulating AI. And that wasn't the answer I was hoping to hear. I think that for now, I think we should let it go and watch it carefully, because I worry that the harm of over-regulation would significantly outweigh the harm of any possible impact from AI as we go. But we should stay very alert to that, watch it, and then see how it goes. Europe is a great example of what not to do. They introduced some pretty harsh privacy and data laws that really froze the adoption of AI in that market and essentially gave it to the Americans and the Chinese. And so we should be very careful not to do that.
Okay. Thank you, Chair.
Oh, tremendous work. Well, I'll hand over to the member for Reid, and then I'll go to the member for Casey after that.
Thank you. And I wanted to pick up on a through line that I sort of saw with your vision for being a energy superpower and the points around housing. And it struck me that really the piece around approvals and planning for both of those grand visions was what was holding them back. Do you think that there is some urgency? There is a debate at the moment around environmental reforms, and part of that debate is that these reforms should make it, if they are passed, easier to get approvals for renewable energy projects and housing projects done faster. Is that something that you think would benefit both of those grand visions that you've outlined?
I think so, yes. I would also add mining and minerals as well to those two in terms of planning and approvals, because there's significant value that our country could get. We have a lot of the resources that the world needs to decarbonize. Copper for conduction, uranium, lithium for batteries, uranium for nuclear that is being adopted in other jurisdictions, rare earths. And so we have a lot of what the world needs, and we've got to get it out the ground. And that's particularly important because the two resources that have created most of Australia's wealth over the last 100 years, coal and iron ore. Iron ore, the quality of the ore in the Pilbara is depleting. And now many of the Chinese refineries need African ore to be mixed with Australian ore to get to the right levels of quality, because we've been mining those bodies for so long. So iron ore is going away, slowly, but it's going to be less of the driver for our country's wealth over time than it has been. And then coal, because of the thermal carbon component of thermal coal, is going to start to become used less and less. So we need new sources of minerals. And we have them. We just got to get them out of the ground. And one of the things I hear from many of our mining clients is that, again, it takes something like 20 years for a mine from conception to actually producing. Recently, Canada has an existential crisis right now because of the economic impact of their southern neighbour to their economy. But the Prime Minister there made an announcement that he wanted to halve the time for a mine to go from conception to production and be a destination of choice for global mining companies to attract capital to Canada. And when you think about Australia and the resources we have, that type of commitment, I think, would be terrific. What I would say is that in the last year and a half, I feel unambiguously that we have a government that now understands how important the productivity of our country is, and that things need to change. And that is a very significant change to maybe where we were 5 or 6 years ago, where I think people were not yet accepting the fact that we had a problem. And now we do. What we now need to transition is from acknowledging and being very aware of the fact that we have a productivity issue to actually really doing something about it and moving from knowing it to acting on it. And I think, I don't think I'm speaking out of turn when I say that it's still early days in moving from knowing to acting.
We have those environmental law reforms that are being debated in the House at the moment. Would you say that if they were to get through, get passed and start to get implemented, that will be a huge driver for productivity?
Yeah, I think a simpler legislative environment will be helpful. But we also need to hold people who are approving things accountable. One of the things that I hear is that there's a lot of duplication between federal and state permitting that is likely very unnecessary. And so why are we forcing in either housing, in energy, or in mining and minerals, forcing companies to get the same approval twice from different places and from different people? And so that duplication and overlap is a problem that we need to lean into as well.
I just want to ask you about a bit of a sort of tangent to your housing discussion. And my view is that in Australia we are not good at getting people into the appropriate homes for their stage of life. And I am thinking in the sense of those who want to downsize, empty nesters and they want to downsize. There are so many kind of friction points and barriers for them to, they've got to sometimes take out 2 loans at the same time if they haven't sold their family home. What is it that we could be doing to make that transition for downsizers
easier?
Easier, yes.
Yeah. Well, I would go back to our tax system is probably one of the biggest impediments. Stamp duty is very significant. And so the transaction costs involved in selling and buying property are really material. And we do hear from many of our older customers that it's an impediment to them making the decision to downsize because of the transaction costs involved. And so, could you look at if you have people over a certain age who are looking to downsize to a smaller property, could we have a tax concession for that? That's an example of something I think as a policy setting we should evaluate, potentially pursue, because what it would do is it would optimize, to your point, optimize our housing stock. The best way to get more Australians into homes is to optimize the housing stock we have, and so having empty nesters in big houses is not the best optimization of our housing stock. So I think it's something that could be interesting to pursue. All these things have costs and consequences. Yeah. But I do think that is an example of the type of issue we face as a country.
Have I got time for more questions, Chair?
Just under 3 minutes.
Okay, great. Just wanted to move into scams. We are operating now in a very sophisticated environment where the individuals who are being scammed, there is a huge power imbalance, and I genuinely feel for those who have been victims here. And I recognise all the work that the banks have done in being proactive. There is now so much sophistication that there's a lot of kind of cloning of legitimate websites. So there would be cloning of NAB banking websites that these victims would go in and try to do due diligence on. What are you able to do proactively to identify these sites and prevent them?
Yeah, that's quite hard. We had, with Meta, an example where we were made aware of fraudulent credit card offers being advertised on Meta platforms, Facebook and Instagram. And essentially it was, a $200 annual fee for a card that was giving an enormous amount of loyalty points associated with that card that were like pretty unbelievable, $1,500 worth of value. And we asked Meta to shut that down. And they did, but what we found up is it was popping up like weeds all over the place. And as soon as we got one shut down, 5 other ones opened. And this is the root of the problem that we need to get our digital platforms to solve for. And I think it's very important. In Australia, as a bank, if you want to open a bank account, I need to verify your identity and I need to know that you are you. And in the vast majority of instances, we do that and we do that effectively. And in fact, we have an ongoing obligation of perpetual KYC where we routinely make sure and update your information, your details, your home, and all those types of things. And more recently, we're asking our customers to actually do a live selfie to ensure that they're a live person when they're opening products. I contrast that with digital platforms where I can open up a digital account with a username and password with impunity. And in fact, I can open up thousands, nay, tens of thousands of accounts with all sorts of usernames without verifying my identity. And this is a problem for cyberbullying, for frauds and scams, for all these types of things. And I feel very strongly that the digital agencies should have an obligation, just like we do, to KYC people who are using their products and services. And it would create for a much safer environment for our children who are using digital platforms, and for everybody involved. And it would make far and away the biggest difference to frauds and scams, because the vast majority of those originate on those digital platforms. The problem that you have is it's economically problematic for those platforms because they make a lot of money based on these advertising for these criminal activities. And so it's not in their self-interest to do so. And because most of those are large international companies, we haven't yet made impacts. But when you look at what the government did recently around young adults not using digital platforms, I think that's a world-leading policy setting, and I would encourage our government to push into this one and see if we can be one of the first countries in the world to increase our requirements for digital platforms to improve their KYC capabilities.
Okay, thank you for that. I'll go member for Casey, member for Morton, then myself, and then we will, just because of how tough I've been on the time, we'll have, if there are any urgent questions that you want to put to the witnesses, we'll have time for that. So over to you, member for Casey.
Thank you, Chair. Mr Irvine, I believe you've got a $300 million partnership with the Clean Energy Finance Corporation. Can you just talk me through that partnership and what that involves?
Yeah, in fact, I might ask Peter to talk to that.
Yeah, no, thank you, Andrew. At a high level, there are two products that we've agreed with the Clean Energy Finance Corporation, where that we offer to customers, and there is they provide I guess a rebate in terms of a lower margin to the customer. So it's essentially we have partnered with the Clean Energy Finance Corporation. We offer our products to the customers, and the CEFC then provides almost like a rebate, if you will, to our customers.
So does the $300 million end up? It doesn't end up with the customer as such. It ends up
reduced interest margin for the customer. Yeah. So I think the two products that we have are an agriculture loan and an equipment finance loan.
Yep.
And in both cases, if the customer application complies with the clean energy setting, it means that we are able to offer a lower interest rate.
So the customer gets the lower interest rate. Is your margin still protected, in essence? Is that $300 million ensuring that your margin doesn't change? So if you were, let's use the EV cars, if you were loaning the $10,000 to someone to buy a combustion engine car, and you're loaning them $10,000 under this scheme, is your margin the same? Is that $300 million essentially covering your margin?
We can fact check that, but my understanding is that it is, and that it's the Clean Energy Foundation that's funding the
the Australian taxpayer is, because the Clean Energy Finance Corporation is the Australian taxpayer. So I guess what I want to understand then is, given NAB's profit was $6.989 billion last year, given we hear this argument that you need certainty on net zero by 2050, and given you as an organisation are committed to net zero by 2050, and that certainty apparently is important for your planning, why is the Australian taxpayer having to pay $300 million to your organisation to protect your margin on a goal that you want to achieve? You know, why do we have examples where Fortescue is delivering a $5.2 billion profit and receiving $45 million of taxpayer money, as per media reports, to look at solar? So there's collectively almost $12 billion in profit, yet the Australian taxpayer, just in these two examples, and I guarantee I could find more, are looking at $345 million, given your organisation has a stated goal. Wouldn't you be prepared to take that margin? Why should the Australian taxpayer?
I think that's a good debate to have. It's for the government to determine why they have programs running like that. My suspicion is that they want to encourage transition, and so much like the rebate for household batteries, that is a current program that's stimulating more uptake of that particular program. And so, that must be one of the drivers as to why it's happening.
So given your organisation is committed, as you said, to net zero by 2050, if there was no taxpayer money available for this kind of program, would you still, as an organisation, to fulfil your commitment, reduce your profit margin to support that uptake?
Well,
or is it completely contingent on taxpayer money?
No,
and if it's completely contingent, then you don't need the target.
Well, I don't think it's completely contingent. There are global investor pools out there that are keen to invest in decarbonisation. There are super funds in Australia that are very strong in their green credentials. There are global, particularly European funds. Norway is a good example. And so it's possible that we could present an economic case to those investors that, we're originating a flow of business that they like a lot, that they might be able or comfortable with a reduced return for that. So it's also possible that we could raise finance from specific investors that could enable that. So I wouldn't say it has to be government. Ultimately, to date, we as a bank have what we call transition plans for our top kind of 200 emitters, where we work with them and we give both incentives to people who are meeting targets, as well as potential penalties for those who aren't, to encourage them to meet their commitments. It's not happening yet, but I think it's quite possible in time that carbon intensity becomes a key risk parameter in a bank's adjudication settings. And just like any other risk parameter, that can therefore drive the rate of interest that we would seek. So we're not yet doing that, with mainstream businesses or even mainstream households.
Just conscious of time, Mr. Evans. Thank you on that one. And you can take this on notice, and we'll put all four banks on notice with this. Are there any other taxpayer funds that your organisation is receiving as part of decarbonisation, et cetera, et cetera?
I'm not aware of any, but we will take that away and come back to this committee.
Because I think the Australian people would be staggered to learn that $300 million of their taxpayer money is going to an organisation that delivered a $6.989 billion profit last year. But I understand that's a government decision and a government setting, not yours. It's not a reflection on you as an organisation. You're operating within the parameters that the current government have set.
And to be clear, we don't get that money. The customer gets the benefit of it.
But it does protect your profit margin. So we can split that many ways. On green hydrogen, ironically, Fortescue actually owe the Australian taxpayer $45 million for their failed green hydrogen plan. We're still waiting for them to confirm when they'll return that money to the Australian taxpayer. Have you previously invested as an or supported financially green hydrogen projects, and are you looking to continue to invest in green hydrogen? And if not, why not?
I'm aware of one transaction that we have funded in the green hydrogen space to date.
Was that when was that funded?
Relatively recently, but I'm not comfortable disclosing the customer.
Yeah, no, understand. In terms of nuclear, would you support removing the nuclear moratorium? And given nuclear is a zero emissions baseload power, if the moratorium did not exist, would that make it possible for private businesses and the marketplace to undertake business cases to see whether the financial situation stacked up in the current environment?
Look, I made some points on nuclear earlier in my testimony regarding the fact that, you know, if we do look at it, that I'd like it to be very fact-based and science-based, and based on economic rationale versus it being politicized, which my observation over the last few years, that whenever we have a discussion on nuclear, it's highly politicized on both sides of the argument, not just on one side of the argument. I think as a bank and private industry, if ever there was something that was legal in that jurisdiction and economically viable, that private industry would choose to participate in it, and we as a bank would likely lend money to it. But that's pretty hypothetical until that is in fact the case.
So you couldn't do a business case to understand if it stacks up commercially while the moratorium's still there? Yes.
Yes.
Thank you. Now, Mark Vassella, the CEO of BlueScope, has said that, I quote, Australian manufacturing is at a tipping point. Energy costs are 3 to 4 times higher than the US, and what was once our competitive advantage has gone. The Deputy Chair listed other examples, so I won't repeat those for time. Given that high energy cost risk to manufacturing, and given manufacturing is a highly capital-intensive business, I'm assuming your organisation will be lending significant funds to manufacturing organisations. Are you reassessing your risk profile for manufacturing businesses? And if you are, like, what is the long-term implications for Australian manufacturers?
I mean, we are still
Last one, yeah.
We are still lending material amounts of money to manufacturing, and it's a significant sector for us. But it's also true that the borrowing capacity for any client is driven by their ability to service the loan. And so to the extent that they have input cost pressure and earnings are falling, that would mean that their ability to borrow would reduce over time.
Yeah, perfect.
Thank you. I'll hand over now to the member for Moreton for 10 minutes.
Thank you, Chair. I was just going to start with energy policy, where the previous member was talking a bit in his last set of questions. So in terms of energy policy certainty and stability, is it your view that certainty and stability in energy policy is important to the NAB?
I think I was asked the question by a previous member of this committee,
yes.
and I responded to say that I think, on balance, businesses like certainty, and capital wants certainty because the costs of these projects are very, very significant, and therefore, and the return profile is often multi-decade in nature. And so, you know, a provider of capital is going to want to make sure that they're going to understand how things are going to work for the period of time that they're going to get a revenue stream against that deployed capital. And so
it's not just you as NAB, it's your experience as the business bank, as you put it,
in
that
any
any
market.
and all businesses benefit and want certainty and stability in the energy space.
I think that's a fair comment.
Yeah. Earlier you spoke about dialogue and narrative that essentially puts forward the idea that net zero and low energy costs can't coexist, and you said that was dangerous. Can you expand on that a little bit?
My point was that Australia is blessed with significant sources of energy, and that uniquely, frankly, we have sunshine, wind resources, hydro resources, and very large bodies of natural gas that we should be able to expeditely bring into our network, because the biggest driver of price increases, and this is economics 101, is always supply and demand. And so if you can bring supply to bear, that de facto will reduce prices over time. The challenge that we have in our country is we have not done a great job of bringing new sources of energy to the marketplace. And at the same time as we're seeking to decarbonize our grid, get rid of those old legacy coal-fired plants and meet the rising demand of energy for things like AI, we're struggling to get all those things done at the same time.
So narrative and narrative and dialogue and statements that suggest that net zero and low energy prices can't coexist is unhelpful to the economy?
I think focusing more of our dialogue on getting projects done, gas sourced, transmission addressed, is a better place to be spending our energy than pontificating about net zero targets, because I think they can both be done.
Yeah. So does that mean that impediments to renewables projects are unhelpful in that ambition that you're looking towards?
Well, let's get these projects done. Let's enable business to prosper. Let's get a look at the planning impediments, the green tape and the red tape, and push these projects through. The federal government has a role to play there. State government has a role to play there. And we just need to become much less tolerant of poor practices and all this time taken to get things done. And if we don't, as I said in my opening remarks, we're hurting households and we're endangering manufacturing on our shores.
And just to come back to the discussion that we were having earlier, there's currently no business case to say that nuclear would be viable here.
Look, I'm not sure I would agree with that comment. There are many other jurisdictions that have made a decision to prosecute nuclear energy, and I don't think that those countries haven't thought that through in a reasonable way. I think what might be different for us than some other places that we have so much significant sources of both renewable energy as well as gas that we may not need nuclear to the same extent that other jurisdictions might. But the notion that nuclear energy is bad and doesn't do what it says on the tin is not proving out in other markets.
Understand. You're saying that renewables is the better option for us. I was going to ask about low-income customers and some of the work that ASIC did when handing down its report. Can you outline the steps that the NAB has taken to implement the recommendations out of that ASIC report with respect to low-income customers being able to access the banking products that they're entitled to, please?
This is something that, as a bank, I don't think is that well known, and something we're incredibly proud of, which is that since 2016, our bank has not charged any account-keeping fees to any consumers in the entire country. And we estimate that we have saved Australians something like $500 million in fees because they've chosen to bank with the National Australia Bank. Have we gotten the commercial benefit of that fee posture versus others? I'm not sure. We probably haven't. Why did we, though, do it? We did it because, I don't think we had sufficient confidence that we wouldn't create customer detriment. And, you know, if we didn't have 100% conviction that we wouldn't be on that ASIC charge sheet that just came out recently because we were charging fees to low-income and marginalised Australians or charging fees to dead people, and we didn't have enough confidence that we could manage that risk, and therefore we chose not to charge that fee.
Do you think that if you have been able to do that, do you think it's something that could be achieved by other banks as well?
I mean, that's for them to decide on. You know, we made a decision.
Let me rephrase. How have you been able to do that?
the bank chose to not charge for that fee, and hope that over time we would therefore get more Australians who would choose to bank with us, because we offer free banking to all of our customers in a way that some other institutions do not. And that's something we're very proud of as a company, and I would hope that more Australians would choose to bank with us as a result.
Okay, thank you.
Good ad.
You good?
Yeah.
Oh, okay, very good, very efficient. You've really had to assume the male form of a Delphic oracle today, Mr. Irvine, and been sought to comment on all sorts of things. I commend you on that. Can I just pick up on where the member from Moreton left off? This is on how banks are delivering services to customers in situations of financial hardship, because that's been a big focus of the hearings. Earlier this year, I think your bank was ordered to pay $15.5 million for failing to respond to customers facing financial hardship within the legal time frame between 2018 and 2023.
Yeah.
I understand you've made some changes to better support customers in financial hardship since then, including, I think it's called the establishment of NAB Care. So I guess I wanted to ask, can you expand on how you've improved that hardship assistance and the processes? As a result of those actions, how many more customers are being referred and receiving that support? And finally, do you have an automated system for hardship request responses? And if any of those questions need to be repeated, please let me know.
Yep. First of all, and I don't want to beat around the bush on this, we were incredibly disappointed about finding that issue. What happened, we put in a new system, this was before many of our times, in 2016, for our NAB Assist team, which is the primary group that reaches out to customers who are behind in their payments. And unfortunately, when that system was built, there was a workflow that wasn't properly, that essentially didn't finish. And so if you had the misfortune of a colleague entering you into that workflow, you essentially went to Never Never Land. You got lost. We would have done.
So how did you discover that?
We found it in 2023 when we were essentially stopping a COVID. We had to introduce a specific provision for customers who were delinquent due to COVID. And as we were doing that, we found this 345 customers were in this queue, essentially, that were lost and not being properly given the service that they need.
Because this is my big worry about workflow design with the application of AI and how you will test the operation satisfies your expectation.
Yeah. So what's frustrating for us is that we must have known about that workflow discrepancy because we were guiding our colleagues in the work practices to not use it. And so that's very frustrating.
That's unfortunate.
And which is what, and then the other reason that we didn't find it, it was such a small proportion of customers who, so we would have done well over 100,000 hardship requests over that time, and there was only 345 that went into this flow. And so, unfortunately, we didn't know about it. We then were addressing this, a post-COVID process that we're essentially shutting down. We found this.
Did you assist those or go back and help those 345?
So we were horrified by it. Yeah. We immediately let ASIC know of that contravention of the code. We reached out to every single one of those customers to check in on their welfare and to see if we could be helpful to them. And thankfully, in most cases, they were okay. And we had a joint statement of agreed facts with ASIC around what happened there. And I don't in any way want to downplay its significance, but what I'm proud of is this is actually a good example of a bank that found something, owned it, fixed it, remediated with customers. We were incredibly sorry and angry, frankly, that it happened, and we've also, as a result of that, significantly improved our hardship practices. We are seeing materially less delinquency in our book, and yet our hardship numbers are way up on last year, which shows that we're identifying it far more often than we were in the past. Don't know if you have the specific figures.
No, thank you, Andrew, and thank you, Chair, for the question. So one of the things that we've...
Sorry, in your answer, do you have an average time that it takes to process a hardship claim?
I think our obligation is to do it within 14 days, but I'd want to check the specifics. So.
Well, if you can take that on notice,
yes,
if your obligation is 14 days, how often, as a percentage, of the claims that you hit that metric?
Yes, no, we'll take that on notice, but there is an obligation from ASIC to respond within a certain time frame, and I'd need to double. I don't have that.
A standard obligation or a specific to NAB?
No, I think a standing obligation is my understanding, but I'll get the information.
Thank you.
For you.
I'm sorry to interrupt your flow.
No, not at all. There are several steps that we took. First of all, we established, Andrew mentioned the NAB Assist team. We created a NAB Care team, which is about 200 individuals that are specially trained to deal with these circumstances, because often when a customer is calling us at what is a very stressful time of life for them, they often don't use the word hardship. So we've had to train our people to recognise from the conversation that they're having with the customer that actually this is a hardship case, and that they need to then take the appropriate action. Our better recognition of hardship circumstances has led to the increase in the cases that Andrew has mentioned. We've also changed the tools and language on our website to make sure it's more in plain English. We worked with behavioural scientists to reframe the language, move it away from what you might call legalese, which meets the sort of like compliance code, to actually what is it that's going to be easy to understand and refer to and guide someone who is in this very stressful life event. So there are a number of steps that we've taken. It goes back to the point earlier about being a learning organisation.
I think it's interesting. I obviously won't speak for members, but I think it is interesting to hear the use of a behavioural scientist to do that. There was an interesting discussion yesterday with some of the people that appeared before us around people's ability to navigate complex terms and conditions, and I wonder whether or not your institution would contemplate. I mean, at some point we do need to think about. We have to confront the fact that these terms and conditions are voluminous. Obviously, a risk aversion to a litigious mindset, but making it easier for people to navigate terms and conditions and potential use of behavioural scientists to aid in that might be helpful, don't you think?
Yes, absolutely.
Another thing I'd like us to be doing more of is having more language options for our customers as well. So if English isn't your first language and having to decipher some of the terms and conditions from banks, that must be a pretty high friction and pretty scary for some customers.
Yeah. Can you take on notice on a quite separate issue? I'd be interested to know whether or not NAB is investing in build to rent.
Very significantly.
Yes?
Yeah.
Okay, I'll put that on notice.
I think we're the biggest build to rent financier in the country, doing a lot of it, and it's starting to, we're trying to see a lot of traction.
Can I test your memory as to what that figure might be?
Oh, it's in the multiple billions of dollars.
But we'll come back to it. On AI, talked about training up people. There's sort of two cohorts. I've heard this elsewhere. That people will likely be threatened in their jobs by the people who know how to use AI rather than AI doing it. I mean, I think there are a variety of... it's a dynamic issue, so there's a number of factors at play. How much does NAB invest in getting your own workforce AI ready?
We have, I think, today, something like 15 or 20,000 of our staff who have Microsoft Copilot use. We are doing multiple online and in-person training sessions to help people start to adopt solutions like that. That's the most democratized solution that we would offer our staff. We have more specific solutions. So we have 4,500 software engineers. All of them have software AI capabilities to help them write software quicker. They're still accountable for the quality of the code, but we are seeing significantly more code being written because they're adopting the AI tools.
I think I might need to just interrupt you just because time's my enemy here. If you could take that on notice, it'd be interesting. If you have a figure that you could point to.
On terms of training?
Training, your investment in training to get your workforce AI ready. There was something that you said when you were talking about account keeping fees that prompted a reminder of something that the CEO of CBA referenced yesterday in relation to getting rid of ATM fees. I think he had a bit of remorse about that. It was kind of pitched as the good idea at the time. And I was really impressed that you said that you abolished account keeping fees and that there was some benefit in that. You see that abolition as a value proposition that has potentially attracted customers your way?
I'm sure there are customers who choose to bank with NAB because we don't charge account keeping fees, whereas others do. Certainly.
Yep. And finally, just on going back to AI, do you ever test your AI chatbots and they're delivering a customer experience that you would be satisfied with?
Constantly. We're very robust in our testing because, at the end of the day, it's a proposition that we...
I know, I'm asking Andrew Irvine if he does it.
Oh, I do. Yeah, absolutely. Absolutely.
Mr. Whitelaw looked askance then.
In fact, he's one of our best adopters of AI.
No, that's so. Okay.
Yeah, I'm pretty keen.
I know you said was it the NPS?
Net Promoter Score. Yeah.
Was good.
But look, we've got to keep investing, and the quality of the technology is improving. My first experiences with these robots were really clunky and frankly unenjoyable. But they've gotten much better, and they're going to improve at a remarkable rate from here.
Yeah, okay. I've got to be hard on myself as I have on others, so I'll wind up my questions. We do have, if there's anything else that people wanted to canvass urgently, Mr. Gregg, have you got some? Okay. Why don't we go, Mr. Gregg, yourself, if you have any final questions, because we'll finish before 5 p.m.
Thank you.
Thanks, Broadcasting, for fixing my mic. Much appreciated.
I just had two. Was that coding error that you referred to before done? Was AI involved in that?
I don't believe so, but I'm not going to give a definitive answer on that. We have humans in the loop. So we
very clearly, our humans are accountable for the code that they write.
Yes, there are no AI agents dropping code into production.
No way.
Human in the loop every single time.
And satisfied with the oversight of that?
Well, in that instance, clearly not, because it led to an incident, and we're running a major incident report to see what happened.
But I don't think that was because of AI.
That's not because of AI. That was simply because there was an error in the code and it should have been tested before it went into production.
Okay. On a happier note, with housing, I was just wondering what changes you've made to your product offerings to embrace new forms of housing, like modular and other forms.
Well, we look at our practices. I think one of the areas where I think banks have been more reticent to lend is on smaller dwelling units. So, one bedroom or studio apartments have typically been more difficult to get mortgages for. And given the cost of housing and the smaller size of households, that's something that we're working at. I think modular is very exciting. I personally went to see one of Australia's biggest modular home builders in Melbourne a couple of months ago, and was actually blown away by how quickly they are able to build high quality dwellings And so I think modular is a big part of the answer here for Australia. Right now, there is an issue with the ecosystem around insurance that we want to see addressed because...
What, on modular?
Yeah, on modular. Because essentially in a normal traditional dwelling construction, the insurance is properly taking the risk away from the homeowner. Right now with modular, there is too much risk to the homeowner when something leaves the factory to when it's fully completed on site. And so our insurance capabilities need to be advanced. And that's something we're a little bit reticent in, and that's a bit of an impediment to how much lending we will do there, because we don't want to be in a position where we lend money and a customer has real harm because they were uninsured on the site. So that's something we want to see addressed.
Yeah, I mean, the modular, it's a great solution. It does have different risk characteristics for the home buyer. So, for example, in the event of a manufacturer's insolvency, the home buyer might be placed in a position of negative equity because they've made payments, but they've got no house or it hasn't even been started. It could be still sitting in a factory, for example, and it's harder to get another constructor if you're building a house, a typical house, and the builder goes into liquidation. You can get another builder to step in and complete the project. Yeah. But with modular, that's not as straightforward. So there are different risk characteristics, and we want to be very, very sure, to Andrew's point around the account keeping fees, we want to be very sure that we can get this right for customers and that they understand what they're getting into and the product is correctly configured for them before we go forward.
But this is a big part of the answer, and we've got to get to a point where we can do this safely and lend money to modular housing in exactly the same way we do for traditional housing development.
So is that something like with stage release of funds and things like that, is that something you're working on, whether you can be part of the solution to that, or are you just waiting for insurance to come out?
No, we're not just waiting and hoping that one day our problems will be solved.
I'm very pleased.
We're very much engaging with modular housing providers, why I went to visit them and talk to them about what we could and should be doing. So, we're pushing into this and we want to be part of the solution.
Yep.
Thank you.
Before I hand over to the member for Reid, I'd have to commend the Australian Banking Association in leaning in on re-examining the mortgage products that would be extended to purchase of modular homes. I think that's helped create an environment that the banks, the members of the ABA, could then contemplate the design of products. So I think it's been very good, and obviously insurance needs to now, hopefully the Insurance Council of Australia can undertake a similar role in dealing with the issues that you've rightly raised today. Member for Reid.
As the biggest lender to businesses, where are the sectors that you are seeing the biggest growth in business lending to?
The biggest growth in the last couple of years has actually been in utilities and energy, but it's still not at the quantum that we need it to be for all the reasons that we've talked about in this committee, but there's been a lot of growth there. Data centres is another big area of capital consumption, which I think is a good thing. Australia's building domestic compute capacity to enable the AI innovation of the future, and I think that's really important for the economic health of our country as well as for national sovereignty. Defence is becoming a very significant growth vector in WA and in Northern Australia. We're seeing very significant growth in the defence industry. And we're very clear that we want to, as a bank, support the defence industry with our lending practices. So that's an area of material growth. And then the more traditional areas are also doing relatively well: commercial real estate, and agriculture. So it's pretty diversified.
Yeah, it does sound like it. And just my final question, Chair. In the time that you've been the CEO, has there been a business that has the growth of which has really impressed you?
Like a sector or a specific company?
Or both, yeah.
I think from a sector perspective, the data center area has been very impressive around how quickly they're growing and scaling. And we're very fortunate in Australia to have some global leaders, AirTrunk and NextDC. These are really wonderful organizations that are, going to create real sovereign capability and wealth for our country and should be applauded. And that's really pleasing to see.
Thank you.
Casey.
Yeah, Mr. Irvine, you did well not to pick really a favourite customer there. It's a little bit like picking favourite kids. You don't want to, you might upset people. So, as someone who spent a lot of time in sales, we love all our customers equally. So, well played there. Just want to quickly touch on deposit deception and the ACCC inquiry that found 71% of bonus interest accounts did not receive the bonus interest rate on average each month over the first 6 months of 2023. So just a list of questions, and happy that some are detailed. If you don't have that detail, we can take them on notice. But does your bank offer personal savings accounts that require consumers to meet hurdles to gain interest?
We have only 2 savings products, which is quite different from many of our peers who would have many. And so we have an interest saver and a bonus interest product. And we regularly look at the rates of customers getting the monthly interest rate. And I think we generally are at 84 or 85% of customers with our bonus interest product who actually achieve the bonus rate of interest. And we are proactive ensuring that customers are well informed. So, for example, if a customer didn't get interest 1 month, we will send them a notification on what the criteria are to remind them of that. Another example is in order to get bonus interest, we want, I think, is it no or minimum number of withdrawals? I think it's no withdrawals.
So the reward saver, if a customer's about to take money out and potentially forfeit the bonus interest reward, they get a warning in the app.
Before they actually make the payment, we give them a warning to say, with this account, you will lose your bonus interest if you proceed. So we really try and again, be on the customer side here and give them the knowledge and information to manage this better.
And have these changes come about since the 2023 inquiry? How recently have you started to put these measures in?
I think we were pretty proud of the fact that our customers were getting those levels of bonus interest rates even before that inquiry. And so I think in our submission, we highlighted some of the things that we were doing that I don't think was common practice. That's not to say that there weren't things that we learned as a result of that inquiry that we also started doing. But I think by and large, this was an area where NAB was doing relatively better than peers.
So we've had some testimony, there's been some others had significant increases from, say, 23 from the inquiry to now, but it sounds like, and you don't need to go year by year, but your increased, which is positive, but didn't have that quantum primarily because you were already at a high level of people redeeming.
Correct.
Is that that's a
correct?
Fair summary?
And I'll tell you, back to our culture as a company, we would have been very unhappy having a product that customers weren't benefiting from. And so if we had a product where 40 or 50% of customers were getting that bonus interest, we would have looked at that, we would have talked about it at management, it would have gone to our board customer committee, and it would have been fixed.
Yeah, that's fantastic.
Two quick questions, one on tech cost and another on scams. On tech costs, the rising tech and cloud services costs feeding into your cost base, are you tracking that risk?
Yeah, no, it's it's material, and the tech companies are very good at making sure that the bill increases all the time. That's why they have such high valuations. One thing, again, that's unique to NAB, we have 3 cloud service providers. So we are not...
not all eggs in one basket.
Not all eggs in one. That's very important. And even more, I don't think other banks are here yet, but we can move 40% of our compute virtually instantaneously between cloud service providers. And what we're seeing from these providers is you're seeing, I'll call it the Uberization of pricing. So when they have compute that's contested, they start surcharging. And when they have excess compute, just like airlines who have unsold seats, they provide pricing benefits to their customers. And so the ability to have multiple providers and the ability to move compute means that we are as effective as we can be at optimizing our costs, but they are material and they'll be ever increasing.
Okay. Finally, before we finish up, the Scam Victims Alliance raised something that really concerned me in reference to the resolution of scam complaints.
Okay.
And it was what really got me is that they would only the claim that banks would only reimburse after prompting victims to sign either a secrecy or a non-disparagement clause. Does your bank engage in that kind of approach? How have you got an opportunity to outline how you try to assist people where they have been scammed to get restitution?